Welcome back to the What You Want More podcast. Today, I am joined with a standing co-host, Mr. Alex Stewart. It's our third show in a row here, where we're actually just so much to talk about from the Silicone Valley Bank situation, Signature Bank, First Republic Bank. And what we're talking about is all of the terms and all the things that are being said in the news. And there's just a lot of things to clear up. And I know in the last two episodes, we went a full deep dive on how we got here, what's happened, a little bit about future impacts, and then kind of coupled that with the Federal Reserve's, decision and what they decided to do. But you made a great point post-show is, hey, listen, we threw a lot at the audience, like a whole lot. Might not be a bad idea just to break some of that down and take our time and explain some of these things as they're hearing more that comes out from the news to kind of help them, decipher what's being said and more importantly, understand it at a deeper dive at a maybe a slower pace than what we did the last two episodes. So thanks for being on the show today.
Absolutely. Yeah, I think that we've seen a lot of fancy words being thrown out. And at the end of the day, this is still a very simple concept. I mean, if people relate it to their own finances, the way we're going to talk about it, I think they'll be able to understand, hey, you just make bad investments. Like eventually you lose money. It's going to be bad, right?
Right. So, as we kind of dive into this here, there's a couple of things coming out upon this collapse, if you may, for both institutions. But what we're finding is there's an underlying problem. There's an iceberg underneath this that's kind of happening on this tipping point that we keep talking about. And that's that a lot of banks are holding what we consider to be, not want to say toxic assets, but assets that are essentially losing money.
Right.
And the only way they don't lose money is if they're held to maturity. And some of these assets can't be held to maturity because of some of the liquidation problems that's happening.
Yeah, and so just to simplify that, with it held to maturity and unrealized and realized, all that, those are probably good terms to start with. So held to maturity, the idea is if I said, hey, I want to buy a 20-year bond, I want to invest my money in a 20-year treasury, that's saying, well, I'm planning on holding it for 20 years, right? So no matter what happens to the market between now and year 19, I'm going to make this amount of money because it's set for 20 years. But the reality is not many people hold them for 20 years, right?
Yeah, no, that's the reality. I mean, that's why bonds are typically bought 10 years maybe, and it's kind of hedged and also packaged together with a lot of shorter term investments to offset that. And in particular cases that we're looking at right now, there's a lot of longer term notes that have been purchased.
Yeah, meaning banks are investing in the long term because specifically there was no interest before, right? Everybody remembers in 2020, your checking account made zero. All of the interest rates around the entire world essentially were pushed so far down through all the stimulus that happened that in order for banks to try to make a profit, to do something profitable with the money that you gave them to lend them, they had to go buy these long-term investments.
Right.
And what are those subject to?
I mean, the long-term investments are subject to the Federal Reserve rates. As the Fed fund
There's interest
rates, right? And as they increase rates, those assets that you bought, those notes that you bought, devalue at the rate in which the Federal Reserve is raising the rates.
And that's because if we were to go out and say you owned a bond and it was paying 4%, but the market's paying 6%, who would want your bond at 4%, right?
Right, so I have to sell it at a discount.
Right.
So I have to sell it at a loss, at a haircut, if you may. And that might be, 70 cents on the dollar. It may be 80 cents, could be 30 cents in some of these cases. Some of them got really devalued. And so that's a challenge in this world that we're seeing that's kind of unraveling on the banking side of things. And I know Jerome Powell and I know President, and the administration want to tell you the banking system, it's great. What they're really telling you is that we're going to back whatever we got to back to make it great. But there's quite a few things that are kind of unraveling underneath the scenes that don't make it that great.
Yeah. So on the way down, it's a good thing, right? Because if you owned all these investments that had these high rates, so you're making 7% and then all of a sudden rates go down to 4%, your investment at 7% is now worth more, right? Because you can't get that anywhere in the market.
Correct.
All you can get is 4%.
That's right.
All right. I think that's a simple concept we want to make sure we illustrate because all these banks essentially bought low and now are forced to.
Right.
That was vice versa. They bought high and now they're forced to sell low, but they haven't been forced to sell yet. And that's why this is sort of the iceberg under the water sort of
Yeah, and that's exactly what's happening because, as we talked about in the last episode, a deposit's a liability. I have to find a way to take a portion of that deposit, what we call banks are fractional institutions. And what I mean by that is they only have to keep a fraction of the actual deposit on hand. The other portion of that fraction, they have to go take and find a way to make money off of that because I can't pay you as a depositor money if I'm not making more money than what I'm paying you. That's bad business, and that's how banks make money. That margin's very slim. In some cases, I have to find a way to lend that money out. And in most cases, that's what banks choose to do. They want to
Right.
lend money in the form of mortgages, SBA loans, car notes, et cetera, small business lending, whatever it is. When the market has captured what 2020 and 2021 produced, which were some of the lowest lowest interest rates on history, most people are like, hey, I'm good with what I got. I don't necessarily need to go get or refinance or further indebt myself and lose that rate that I secured. So then the banks go, well, okay, I still have a commitment to you as a depositor. Where am I going to go make that money? You know what? I'll go put it in a safe place with small margins where I can make a difference between what I'm paying you. And that's how we saw so many banks make their way over to the mortgage-backed security market and also to the notes that we see on those 10-year notes that they forward committed to.
Yeah. Well, it's interesting. I know we both have a Wall Street Journal article pulled up to help us reference some things. And really this trouble didn't start until basically the end of 2021, right? Because that's when the rates started to tick up. And could this go away, you think, if rates went back down?
It would take a significant swing for them to come back down. I mean, we're not talking like a quarter adjustment. Like, you got to think they would have to come down to the value in which these were actually bought. And some of these were bought in, 1.25, 1.5, 2.0 for a 10-year note. We're currently sitting at 3.64 as we have this conversation. So there's a significant difference in the value of what they purchased at to what it is today. But I did want to say, someone might be going, well, why in the heck did they buy these if they knew rates were going to go up or be increased? I would say that there's a term that we talked about earlier, the hold to maturity. As long as they kept that for the maturity, the term of that actual note.
Well, that's just a category, right? They're essentially saying, we own this and we've currently got it categorized as we're going to hold it until it's done.
But my point is, as long as they hold it for the term of that note, they're guaranteed to get their money back. And I think that gets missed in this whole conversation where people are like, well, why would they buy 10-year notes? I don't understand that. Well, because it's a risk-free. Obviously, it's not, but essentially it's backed by the federal government, meaning that you may not make a lot of interest, but if you buy $10 million worth of 10-year notes, at the end of that term, you're going to at least get your $10 million back. You may not get interest made on that, but you're guaranteed the initial investment back. And I think that gets lost in this conversation because a lot of newscasts and sources and outlets are like, this was so dumb. How did they not see that coming? And I think our last episode, we talked about the stress test. There's tests that the FDIC implements on banks known as stress tests where they try to stress your assets and your liabilities and then see if your bank can handle any type of, let's consider these words, stress that you put on this basically portfolio you have, right? How are your ratios going to look? Are you underperforming? And so those stress tests were just, unfortunately, they weren't accurate in the manners in which they were stressing that 3-year plan. They were using a 3/4 rate hike for over 3 years when we had that 3 of those over 3 different FOMC meetings. So it wasn't a good test. It wasn't a good implication of what's going on, meaning that you have 3 different hikes of 0.75. That's roughly what, 2.25 to the system? Well, that's a lot different to your investment on these 10-year notes than 75 basis points over 3 years, right? It deteriorates that investment at a much greater term. And so I think the stress test was flawed, and we talked about that.
So it's just maybe another way to explain this. If you're standing up and you have a small guy come and push on you, and they claim that that's a stress test to see if you fall over, you're saying what they should have done is had the rock come push on you and see if you fell over, right?
So you fall over, right?
Right.
And that's exactly kind of a great analogy of how it's going to work. And that's exactly what happened, just a poor test to kind of indicate what could happen. But I did want to say a lot of banks were doing what Signature and Silicon Valley and even the First Republics, they're all doing it. And so the Federal Reserve came and said, hey, listen, we'll do a collaborative, like essentially swap or buyback program. And what we just described, the Federal Reserve saying, we will make you whole on most of these that were purchased in 2020, 2021, and 2022. We'll make you whole on everything. You don't have to wait to the term. We'll go ahead and do it now. And in turn, you'll pay us back, but we're going to go ahead and get your balance sheet in line. And the reason they want to get it in line is because on that fractional deposit that I'm talking about, if a bunch of depositors come back and they start wanting their money, I have to have the ability to give it to them. But if it's tied up in these held to maturity assets,
well, you have to realize the loss, meaning you have to actually sell what you've invested in, and it's very much underwater. You've got a huge loss on it to be able to give the money back, and that's part of the problem of what we saw.
To arise. Yeah, that's where the issues start to arise. As we take a look, again, Silicone Bank was not the only one doing that. I mean, if you look across the entire banking system, it's literally almost every bank is in some position like that. And that's why I think the Federal Reserve said, hey, listen, we'll do a temporary buyback swap program because we can't have this run, if you may, happening at other banks. I mean, if you have one run like you did at Silicon Valley Bank and you can stop it, and you can correct it. That was what were those guys thinking over there? What were those execs doing? If you have it at 2 and then you have it at 3, you have a contagion is what they call it. And that's all of a sudden a domino effect that starts happening, and it's panic. That's pure panic setting into the system. So that's why you have to have this buyback swap program available to get these other regional banks that are more in jeopardy than your big Power 5 or Power 10 banks. You have to get them whole to where if they have a run, people can come and say, I need my money. And they're like, hey, no problem, we got you. But the first time they say no, that's where the problem's going to happen.
Well, and the only way to really avoid this, would you agree that it would be to say, okay, you deposit your money with me, I will give you no interest, but your money will stay in my vault? Is that the only way that we would have avoided this?
No, because then the bank wouldn't make any money at that point. So I would say that wouldn't work, because then the bank would end up shutting its doors because they've got to pay, team members, they've got to pay other obligations. That wouldn't have worked out. That's why you have to have a fractional deposit system. I think what would have caused this to be better is if there were more mortgage lending taking place, more SBA lending taking place, more other loans that are longer term, higher interest taking place to offset what I would either give you or not give you to have that money in the vault. And I think the challenge is that as the Federal Reserve wants to tighten the system, and that's what they're doing right now. They want a quantitative tightening. That's been their kind of their desire, if you may, because if they can slow the supply of money inside of the system, that's how they want to fight inflation. The offset of that is in doing such, you're raising short-term interest rates, which are negatively impacting the portfolio of these banks, and they've been warned against that. And then you're also squeezing the money supply, which in turn de-incentivizes banks to lend money out. So the remedy is actually, it's not there, because you're doing all the things to cancel what would normally be this remedy in the situation. Banks don't have the affordability to do exactly that. And then you couple that with fear or pandemonium, if you may. That's a bad formula. It's a recipe for two banks collapsing is what that is.
Absolutely. Yeah. It's interesting that it feels like people couldn't foresee this, but I think you and I both know that the other aspect of this is just like in the mortgage industry, there are rules that are written for this, and we operate under those rules. And as long as we're following those rules, that is what it is. That's the name of the game. And I feel like banks are in this similar position where, again, these regulators say, well, these are what you need to do. So you do these things, and then hey, I complied with what you asked me to do.
Yeah, and I think what you're referring to is the Dodd-Frank Act, because the Dodd-Frank Act in 2008 had a lot of things built into it. I mean, we could probably take up a whole season of what was in the Dodd-Frank Act, and still is in there. But one of those particular rules you're referring to was the fact that banks, the way they report the hold to maturity that we just referred to and explained, anything that's been marked hold to maturity on the balance sheet, you don't report those losses, those unrealized losses, as they call them, because it's not realized, because as long as I hold it to the maturity date, I'm guaranteed to get that money back. And so you got to ask yourself, well, why in the hell would they put that in the Dodd-Frank Act? Like, that doesn't even make sense. Well, what was going on in 2008? We had a financial crisis, right? And so the government wanted to encourage banks to invest into the treasuries. They wanted to encourage banks to invest into the United States government. So what better way to do that than to say, let's come up with this new balance theory to where if you do it, we're always guaranteeing to get our money back on anything we put into the treasury, if you may. But now if things get bad, we're not going to make you report the losses. Well, what does that help? That helps stock prices. What else does that help? Investors on Wall Street. What was the one thing they were trying to correct in 2008?
They were trying to get Wall Street right.
They were trying to get it right. So what better way to do that than to say, hey, put your money over here in this safe haven. We got your back. But by the way, we're going to move these rates, right? One way or the other. These bonds may yield or may not yield, or these notes may or may not yield. But the reality is, at maturity date, we're going to get you the money you put in. And what better way to incentivize that than saying, as long as you mark it hold to maturity versus available for sale, those are the two ways you would mark those right now, AFS or HTM. But as long as it's marked this hold to maturity, we're going to give you a pass on any type of unrealized gain loss. And that worked for years. Why? Because interest rates went backwards and got down into the zeros. And so anything that was bought during that time gained significant value. Well, the flip side of that, here we are now when we're starting at zero and we can only go up to and fight inflation. That math doesn't really work towards the investment theory that they wanted to do in 2008.
Yeah, it's interesting on this Wall Street Journal article, one of the headline numbers that stood out to me that I know is what caught my eye and brought this article up to all of us is that there is a estimate that there is 1.7 trillion in unrealized losses on banks' balance sheets.
Yeah.
Now, it's funny. I sent out a newsletter to my subscribers at the Market Distillery, and to quantify one thing, it was thousands of millions. And I almost texted you to say, Quentin, I need you to help me understand what this actual number is. If it's 100,000 millions, what actually is that? That's got to be a big number. That's only a billion, 100 billion.
Yeah.
Okay, so 1.7 trillion would be 1,000 billions.
Yeah.
Right?
That's correct.
So it's 1,000 billions, which is a whole lot of millions.
Yeah.
I mean, this is massive. That's why I think why are we doing 3 episodes on this, and why is it? Because this is so significant that we're trying to understand it and trying to help everybody else understand it, not to create fear or panic, but just to have an idea what's. I mean, 2008. You rewind to that. Like, I feel like we had to wait until the book came out. Wait until The Big Short was released to actually get an idea of what happens. But right now, data's so available. And we're in this new era where we can actually kind of see what's happening live. That's incredible.
Yeah, when I take a look at that 1.7 trillion, and that's according to the University of New York or New York University professor that did a study on this. The reality is that is a ton of money. The FDIC, if you may, just to put in perspective, the FDIC's insurance pool, that fund that everyone keeps referring to that the banks are going to have to pay more into, whether it's a one-time fee or they actually spread it out, that's only $183 billion. I mean, don't get me wrong, that's a lot of money. But in comparison,
sounds small compared to 1.7 trillion.
1.7 trillion, that's not even remotely close. And so that's another reason I think the Federal Reserve had to step in with the Treasury, with the authority of the president and Janet Yellen, and say, listen, we got to make all these depositors whole. We have to have a buyback program because we're literally sitting on a house of cards right now, because if for some reason another bank has a run, we're going to see significant issues such as what we're seeing right now. And we started to see signs of that at First Republic. And then what happens is it usually bleeds into overseas too, because what's our problem becomes their problem, and what's their problem becomes our problem. As much as we try to avoid it, that's how the financial system works. You saw the likes of Credit Suisse, and then you saw the likes of Deutsche Bank, and you saw people stepping in to help them. And whether that's the right thing or the wrong thing to do, you've got to stop that contagion, as they're referring to, because that domino effect, we're probably not even addressing the fact how many of these exact same notes are held by foreign banks. There's a lot of foreign participation that takes place in the U.S. Treasury in the form of other countries and other banking systems buying those notes.
Because guess what they had in Europe?
That's correct.
We didn't have negative rates.
They had negative rates. Right.
They were even more incentivized to go find zero was a great number for them because it wasn't negative.
Yeah, you're going to give me 1.25 sold. And so they have the same problem in those banking systems on their asset portfolios that make up the same thing that we have here. And so we can't be naive enough to think that that's not an issue that's going on over there. And by the way, our inflation, it's at 6.4, I believe, around there.
6.5.
Yeah, and in the UK, it's 10.4 right now.
Yeah. Do you feel like this is a little bit of like, as long as we can run faster than the other people, the bear will get them instead of us?
Exactly. Yeah. I also think this is a perfect example. We've said this is probably the 3rd time we've said this, but this is an example of fishing with dynamite. I can't stop saying that enough, because anytime you fish with dynamite, something is going to come up. It may be a grouper, it may be a red snapper, but when a whale comes up, that's when you start to go, wait a minute, we got a big problem. And I mean, environmentalist stuff aside, I'm using this as an analogy here. Whales come up, that's an issue. Everyone starts to notice. You can't miss it.
Yeah.
And in this case, some of the whales are the banking system, and now the European banking system.
Right.
And when the central banks have to step in, that's not a real good sign,
Right.
And I think Jerome Powell was even caught back a little bit last week in his press conference when he was asked, is this something you're going to continue to do for all the banks?
Right.
And he really deferred and said, was asked, what advice are you giving to Congress to avoid this from happening again? And his response was, I don't really give advice to Congress. And I'm like, well, that was the craziest damn thing I ever heard, because you testify in front of them about every 6 months, and then you also talk to them every month about what's going on. So it sounds like to me you advise them a lot. And he just kind of really was caught off guard and dodged the question altogether, because the reality is what the Federal Reserve is going to do is at all costs, they will keep printing. They will keep supporting the banking system, because everything aside, they're not going to lose that. And that just means they're going to further add to the inflation problem that we continue to talk about, adding more money into the supplies.
Yeah. A colleague of mine sent me another Wall Street Journal article, and it said, like all central banks, the Federal Reserve was designed to make money for the government from its monopoly on issuing currency. So normally, obviously, they buy these bonds, they give money to the economy, and they actually make the money on the investments, because guess what? When you print the money, it's like an infinity profit margin, right?
Correct.
Because it was never existing. This had, as of September 22, they have lost $42 billion. The Federal Reserve has lost $42 billion on these investments of basically buying off these debts that are not worth anything. That's only going to go up, because that doesn't even include anything that we're talking about now, because that's from September of 2022.
Right.
It is very interesting, because also it seems like the solution to this, which is getting interest rates back down, leaves us at the same position we were before we got into this, right? I mean, what do we do from here?
Yeah, I think the reality is the Federal Reserve, when they raised it that quarter, that was more of a head fake. And it was up to them to say, hey, listen, we're not going to give up on what we're trying to do, which is address inflation. And we don't want to look like we're weak and that we're ready to back down. But by doing it a quarter, and then the commentary that followed is exactly what they're going to do. You just saw a sign of them saying, we realize there's an issue. We're going to hit the pause. We're going to do that on the next run. And you're also recognizing that if they go backwards, if they start to reduce rates, we are already in quantitative easing the minute they put money back into that. The second part of that is reducing the rates. And I think they're at a standstill where it's like, okay, we know, I heard him say this the other day. They had we always have core inflation. They now have something they're looking at called super core inflation. I mean, they talk
Sounds
about,
cool.
hey, you know what? We're just going to keep moving the goalposts as far as we can here. But the super core inflation, I really think, has them kind of this belief that they have it under control right now. Because if you strip out all the things they strip out to get to this super core, they're at like 3% inflation. They're not at this, and they really believe that that's the metric they need to focus on. So that's why I do believe they're going to hit this pause button. I think they wanted to send that signal. And the reason I say that is because Powell said, we want to make sure we didn't shock the system, and that we've been able to kind of, tip our hat and show you, or basically let people know what our plans and our intentions are. And that's a way of saying that, hey, listen, we're probably hitting the pause button here. And I think that's just equally as dangerous as going backwards and maybe reducing a quarter or whatever. So what has to happen here? Alex, if I had the answer to that, I think we and I would be sitting in different positions, but I think what has to happen is this. I think the banks that are in critical positions right now, I think the depositors need to understand that making a run on the bank's a bad idea, that if you want to move your money—
Unless you're first.
Yeah. But the reality is this: there's no reason to panic and say, hey, I need to move my money. Your money is safe at the banking system, and the Federal Reserve just showed you why, along with the U.S. Treasury. So I don't think there's anything to worry about there. I think the buyback or the swap program, the Federal Reserve, I think almost every bank needs to take advantage of that is in a position to do it. I mean, if you take a look at some of these banks that we talked about in our last episode, some of them desperately need to make that swap position with the Federal Reserve.
Which we have seen, by the way, the numbers for the lending that comes out, the primary lending, right? So the first week that this came out, they rolled it out, and there's like $153 billion worth of money borrowed. We did another 110 the following week. So there's a significant amount of participation happening for sure.
I think the markets need to quit guessing what's going to happen and building it in. I think we need to quit trying to think the Federal Reserve has telegraphed what's going to happen and that you can just build it in, whether you're building it in pricing, you're building it in the stock, whatever you're doing in the equities. Stop trying to build in what you think they're going to do and let it happen and react to it, and don't try to price it in. Because I think when you do that, that's when we get false signals, and that's when we see these rampant swings that we're seeing. I mean, we're seeing the Treasury jump 14 to 16 points a day. For the record, for our audience, that doesn't happen. Like 2, 3, 4, 5, that's normal. 16, that's a big swing. And I'm talking 16 up and 16 down. The last couple of days, last week, we were at 24 and 25. Like, that shouldn't be happening. That's because the market's pricing in future expectations. And then when it doesn't happen, you have these huge swings, right? Add to that some volatility amongst the banking system, and that is a big windfall on the 10-year Treasury. Shouldn't see that. The other thing is this. What we're experiencing right now is that if your bank is not paying you, let's say 3.5%, 4% right now, comfortably on any type of account that you have depositors that have very large deposits at these banks. I'm talking like millions, whether it's in payroll companies, the payroll portion of their company, or just their own personal, being there. They're pulling their deposits and they're saying, well, I'm going to go invest this in, either A, a bank that's going to give that to me, or B, directly to the treasuries because it's short term. The 90-day and the 6-month are short-term T-bills. And so the challenge is, as they've risen these rates at the rate in which they've done for the Federal Reserve by constant raising, they've incentivized people like you and I to go pull our money from a bank and invest in treasuries. Well, that's also causing run on the banks, right? Because if I'm going in there saying I need my money and you're going in there saying you need your money, well, that's forcing the banks to liquidate some of these hold to maturities or available for sales that they had, and that's hurting the system as well. Yeah. So getting those rates down, getting those short-term rates down, that's going to help. We need to get that to get done as well, so it stops incentivizing people to pull money and take it elsewhere. Yeah. And then the last thing I'll say is this is from a commercial lending standpoint. I think that's the market that's potentially I don't want to say in danger, but I think could potentially experience the bulk or the brunt of what just happened, because commercial real estate was already struggling. I mean, there's a lot of people that may argue with me and say commercial real estate's back, but we still have a huge work from home force right now. And that doesn't appear to be coming back at a rapid rate. It appears to be, okay, this is going to be the normal for the amount of people that are working at home. I think it's like 18%. That appears to be what it's going to be the standard now. Well, that 18% used to be in the office. Right. You used to have space for that 18%. Now we've got vacancies. Right. So you already have landlords that are sitting around scratching their head going, okay, I've got to lower either my rent roll, the cost per square foot to attract more renters, or I'm going to have this available space that's just vacant and sitting here, and that's affecting rent rolls. Well, when you affect rent rolls on commercial real estate, that eventually affects the loan program too, because it's all based on the amount of rent you're getting in during that term of the loan. And so if you start messing with that, that could mess with loans. The other thing is, if you're de-incentivizing banks, regional banks, to lend out money, that also slows down development. It slows down rehabbing of current rental spaces. It slows down a lot on the commercial side. And I think that that's a risk that starts to happen when you see this tightening phase take place by the Federal Reserve as well.
Yeah, so I'm hearing there's going to be a stark difference between residential real estate. So if you want to buy a house, it's not going to be harder to get a mortgage. It's not going to be something that's going to necessarily cost you more because rates may be coming down. But on the commercial side, it potentially is going to be a night and day difference where it's going to be very difficult to get any sort of financing. And there's a lot of open space, so you're not going to necessarily be able to get a whole lot of rent for it, right? Is that what you're saying?
Yeah, I'm saying that's exactly right. The residential and the primary residence market, that is going to continue to be a market that has an upside in what's going on right now, because I hate to say it, but that might be the winning market either way. Yeah. But if they reduce rates, that's easy to figure out why that's a winning proposition for them. If they increase rates and they continue down this path, well, we've already seen the resiliency of residential real estate. It hasn't collapsed. I mean, Lord knows everyone's been calling for it. Not everyone, but there's been a lot of people calling for it. And the reality is, the thing that we continue to not give enough attention to is the supply and demand curve in real estate. And the fact is, I think our good friends over at MBS Highway showed us there was like 968,000 homes available in the entire United States. 40% of those were currently under contract. So that roughly gives you just a little bit over 500,000 homes available for purchase. Right. But yet we know that the household demand market is almost 3 million people.
Right.
And so what we're finding out is that the homes are going to continue to hold their value because of supply and demand. And you can make argument there's pockets in the United States that doesn't hold true to, and I would say there probably are. But we're talking about the majority case here, that is supply and demand is going to continue to be an issue. And so if rates come down, well, that demand's not increasing, right? Because the only way that demand is not going away, it's only increasing, and supply is not getting better. The only way to get that supply better is to build more homes.
And we just said the loans to do that are going away, right?
That's exactly right. So you're talking about the commercial lending problem. And the commercial lending problem doesn't just stop at commercial real estate. It stops at builder loans.
Yep.
Because when builders need commercial lines to build homes and that market becomes tighter, builders typically go, okay, well, we're going to change our projections. We're going to slow down on the VDLs, the vacant development lots, and we're going to stop going vertical on properties. And we'll hit the pause button because we're not going to repeat what we did in '08. And so I think that there's where another challenge lies for that particular inventory issue that we just talked about. I just don't see that getting better. Right. And even if we could stay on the pace of 2021 builds, that was a much greater pace than 22. But if we could stay on that pace, we would need 5 years just to get caught up.
Right.
And we're not going to do that. So I think that's why the supply inventory issue is going to continue to be an issue and going to help the residential side continue to grow.
Yeah, well, it sounds like there's some things we can use there to anticipate what's coming, to position ourselves. And ultimately, I know our goal here was just to go over a lot of the basic details of what we're talking about. Because there's a lot of terms thrown around. There's a lot of news being talked out there, but I like to look at us as trying to make this easily understandable and accessible to the general public. So
yeah, and we got some things coming out this week that are going to absolutely change and add to what we're talking about with the PCE coming out this week, which is the Federal Reserve's favorite form of inflation. And remember, inflation is a lagging indicator. It's a 12-month lagging indicator. So all the stuff we're getting now is rear view mirror type stuff, but it is how they make their decisions, right?
Lord help Jerome if that number comes out high. What is that man going to do?
It's going to drive him nuts. So anyhow, we'll stay tuned for that as that comes out this week here. As always, Alex, thanks for being on the show here. How can we learn more about The Market Distillery?
TheMarketDistillery.com, as well as on Instagram at The Market Distillery. We love charts, pretty pictures, data, all that good stuff. But the main focus there is making things easy to understand and making things practical. Yeah, man. Well, great. I appreciate it. I know you're doing a wonderful job out there. I also follow you online. I think it's great. And if you want to know more about our show, just share this episode. You can share it with Apple Podcasts, Spotify, also Google. Just recently got put on Amazon, and then we're always on YouTube as well. And then check out our handles at What's Your One More on all platforms. Thanks again for being on the show, Alex. Thanks, Quentin.
Yep. All right, Charlie, we're out.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into